Hi, Charles Sizemore here. And so for this week's video, we're going to do another dividend stock of the week, and we're going to revisit a stock that I've covered in the past, but it's been a while since I've really done much with this company. It's the business development company Prospect Capital, ticker symbol PSEC, PSEC. Now, this company is exciting to me for a couple reasons. One, we're still in this sort of reopening play right now. I know that was the big trade for the first couple months of 2021. It looks like that was sort of flagging a little bit, and tech stocks have sort of rallied a little. But I do think the bigger theme of the next, the year from going forward from now, is that we are looking at a world in which things get closer to normal every day. And that's what makes business development companies interesting, because this is as close to Main Street as Wall Street is ever going to get. One of the biggest disconnects during the pandemic was that while sort of middle America, Main Street America was not doing well at all, corporate America was doing fine because they're large, they have scale. A lot of times they have the ability to have their employees work from home. It's just a different world. These smaller companies, smaller businesses, a lot of them just did not do as well during the pandemic. They really struggled. That's where business development companies get interesting. Business development companies, you can think of them as almost like a private equity company for regular investors like you and me. You and me can't go invest in a private equity fund, generally speaking. Like the minimums are too high. But we can buy a business development company, which is kind of in principle a very similar deal. Business development companies provide debt and equity financing to what they call middle market companies. These are companies that are too big to just go to the bank and get a small business loan, but they're not quite big enough to go to Wall Street and issue a major bond issue, issue a stock IPO. They're not quite ready for that. They're not quite big enough for that. But again, they've outgrown the bank. They've outgrown kind of entry-level financing. So they're stuck in the middle. That's where a business development company, a BDC, can really add value. They come in, they provide the financing. In a lot of cases, management helps, like a private equity firm. The management team of the fund actually helps the business. They actually coach management. They help them more than just with capital. They actually advise them on how to get to the next level. So that's business development companies. Why is that interesting now? Well, these middle market companies are precisely the companies that didn't do so well during the pandemic. They suffered and they really got beaten up. And the share prices of the BDCs by proxy also really got beaten up. Now they've recovered massively over the last couple months. But I think that as the recovery gains speed here, as things really do get back to normal, I think there is a lot more to come. And that's where, so backing up for a minute, that's what makes Prospect Capital interesting. It is one of the largest business development companies. Its portfolio of businesses, about 2/3. Let me back up again for a minute. It's 2/3 of its portfolio is in first lien financing. I like that, particularly at this stage of the recovery. Things could slide backwards. Once the government stimulus runs off, you could have the economy stall out a little bit. I do like the fact that Prospect Capital, their main, the bulk of their portfolio is invested not in equity, which is more volatile, but in debt, and specifically first lien debt. That means if their borrower is not able to pay, they get the assets. They're first in line there. That's important. You really don't want it to ever come to that, because that's not, you don't invest in a company expecting to take the collateral. The collateral is what you get if things don't go well. But it is good to know that they have that level of safety. Now, Prospect Capital has sort of traditionally traded at a discount to its NAV, its net asset value. That's pretty common in the world of BDCs. This stock got beaten up so bad last year. It was crazy. At one point in time, it was trading for 50 cents on the dollar. It was trading for 50 cents or 50% of book value. Now, of course, book value itself was sort of a question mark. No one really knew what these companies were worth in the pits of the pandemic when there's no buyers. And what's it really worth if no one's there to buy it, right? But it was worth, at least on paper, 50% of book value. It's recovered to about 91% of book value, but you're still at a discount. As a general rule of business development companies, with very few exceptions, I do like to buy them when they trade at discounts to NAV. It doesn't guarantee profits, of course, doesn't guarantee that your investment will pan out, but I would much rather buy $1 worth of good assets for 90 cents than $1.10. Obviously, it's better for us if we buy at a discount. The stock also pays a whopping 8.23% in dividends right now, which is fantastic. As an added bonus, the stock pays that dividend monthly. I've always said I never recommend a stock because it pays monthly, but it's certainly a nice bonus. There's no reason why companies have to pay quarterly, or European companies actually pay semi-annually. They pay twice a year. It is pretty arbitrary. And so I do like companies that think somewhat independently and are willing to do things a bit differently. And in this case, pay monthly. That's good. Now, one thing that makes Prospect Capital particularly interesting and really sets it apart from some of its peers is the level of insider buying. Well, institutional buying is a different deal, but insider buying. So the people that actually own and well, not own, but the management team, the C-suite executives, these guys own a ton of the stock. The CEO, John Barry, he owns about 70 million shares. Now, not quite half of that, but 31 million of that he bought last year alone. Like, he saw the stock price crater during the pandemic. He swooped in and just dumped a ton of his own money into the stock. Now, this is an important distinction because a lot of executives get stock options or whatever. This is not him getting stock options from the company. This is him opening his checkbook and writing a check or going to the bank. This is him actually taking his personal money, his personal wealth, and investing in his own stock. That shows a lot of commitment. When you have 70 million shares worth, at today's prices, that's $600 million or so. That's a ton of money to have tied up in your stock. But he does. And, I can think of no better endorsement of a company than to have the guy running it, the CEO, put that much of his personal wealth in it. That tells you that it's, look, a lot can happen. There's a lot of unknowns out there, but this is the guy that runs the company. He should know some things, right? If the possibility for failure, outright failure, just the possibility that the company would come under distress, I would say is extremely low. You wouldn't be dumping tens of millions of your own dollars into the stock as the CEO of the company if you thought there was any chance you were going to lose that money. If you thought there was any chance that this was going to go belly up or going to blow up or something, you wouldn't have put that kind of money into it. So the fact that Mr. Barry here has plowed that much of his personal wealth into it is about the strongest endorsement of the stock I could actually find. Now, there is one sort of, I won't call it a red flag, but there is one thing that is somewhat off-putting about Prospect, and that is these guys, like many other business development companies, they pay out virtually all of their profits. Are required to by law, actually. They pay out virtually all their profits as current dividends, which doesn't give them a lot of wiggle room when times get tough. Sometimes they have to cut the dividend. Now, some of their peers, for example, Main Street Capital gets around this because they have a lower monthly dividend that they top up a couple times a year with a special dividend. That way they satisfy the IRS rule that they dish out 90% of their earnings as dividends. They satisfy that, but they have a bit more flexibility and they don't have to lower the dividend if times get tough. Prospect doesn't do that. And so, they have gotten into trouble a few times in the past, and, though I would say not recently. But overall, this is a compelling proposition right now. You have a stock in a sector, business development companies, that I expect to do well in the coming months and coming years as things get back to normal. And these middle market companies that Prospect provides financing to are really going to recover and do nicely. That's what happens in an economic recovery. The more marginal businesses, they survive, they thrive, they do better there. So we're starting with that. This is a nice sector to be in to start with. Apart from that, we're getting it at a discount. The portfolio, the stock right now is trading at only about 90 cents on the dollar value of its portfolio. That's good. A bigger discount's always nice, but a 10% discount there is nothing to sneeze at. And then finally, it does pay a very nice, high, attractive yield of about 8.23%. Now, the rules here. Whenever we talk about a stock here in Money and Markets, we do like to drill into our green zone rating system and see how it rates. We're quantitative based here. We don't just pick stocks at random. We like all of the right boxes to be checked here. We like it to check out on our screen, because at the end of the day, none of us are truly objective. We all have our biases. So we really want the numbers to check out. Well, they do. Overall, the stock rates well. It rates an 89 out of 100. That's very solid. That puts it in strong bullish territory by our scale here. In Adams back testing, strong bullish stocks, which is anything with a rating of 80 or higher, tend to outperform the market over the next 12 months by a factor of 3. They tend to do 3 times better than the market, at least they have historically. So that's certainly a very, very nice nice score there. A score of 89 is solid. Now, digging into the details, the stock rates phenomenally well based on volatility at a 97. What that means in plain English is the way we look at this, risk-adjusted returns and whatnot. It's actually less volatile than 97% of the stock starting universe. So that's good. Over time, lower volatility stocks tend to outperform higher volatility stocks, and they give you a lot less heartburn in the meantime. Now, it also rates very well on value with a score of 93. Again, that's not at all surprising, given, like I said, that it trades at a nearly 10% discount to net asset value. You could hypothetically buy up all the shares of this company, sell it off for spare parts, and walk away with a 10% profit. So that's clearly a cheap stock. That's good. It also rates well momentum at a 91. Now, a lot of that is because of the last year. In the last year, call it last 6 to 8 months here, the stock has really had a nice run. Now, it did horrible in the pandemic. In the early months of the pandemic, the stock really just got destroyed. But it's been shooting up like a rocket ever since. And our momentum score is reflecting that. So that 91 in momentum, that's reflecting this very strong performance over the last several months here. Quality, it drops off a bit, but it's still a very respectable 61. That's nothing to laugh at all. Size, it rates a 40. That's okay. That's mid cap. It's sort of upper end of mid cap territory. That's smaller is better, to find some unloved, unknown gem. But 40 is not bad. And then finally, if it does rate poorly on any particular metric, I would say the growth score of 37, that's not great. That's okay. This is primarily an income play. We're talking about dividend stocks of the week here. So it's not a deal breaker that it doesn't rate particularly high on growth. Higher is always better, but again, if you're going specifically for income here, that's not bad. So overall, don't load up your entire portfolio with nothing but high yielders like this. But I think there is definitely a place in your portfolio for some of these. I'm a big believer in dividend growth, but I also think peppering in some monster yielders in there is perfectly fine, and I encourage it actually. Prospect rates really high. So in our case here, we're getting a very nice, over 8% dividend with what I believe is the possibility for really solid market-beating returns over the next year or possibly beyond. So that's going to wrap it up for this week. We'll hit this again next week.